The S&P 500 has officially entered a bull market, closing up more than 20% from its October lows. This marks a significant turnaround for the benchmark index, as the recent bear run lasted 248 trading days, the longest since 1948. Despite facing challenges such as an aggressive Federal Reserve rate hike campaign, regional banking turmoil, and persistent recession concerns, the S&P 500 has shown remarkable resilience. According to research from Bank of America, the S&P 500 tends to rise 92% of the time in the 12 months following the start of a bull market. This is higher than the historical average of 75% over any 12-month period dating back to the 1950s. The fact that we are back in bull territory could potentially rekindle investor enthusiasm for equities. Bank of America's Savita Subramanian and the equity strategy team noted that, if investors experience lower returns or negative opportunity costs in bonds, they may be incentivized to return to equities, particularly those that benefit from rising real rates, such as cyclicals. This shift in investor sentiment could lead to further gains in the stock market. While the path for stocks might not be linear, historical data suggests a positive outlook in the long run. Ryan Detrick, chief market strategist at Carson Group, analyzed 13 instances since 1956 when stocks bounced up 20% from a 52-week low. In the first 3 months following the bull market entry, stocks tended to be volatile, with the S&P 500 actually falling 0.5% on average in the first month. However, over the next 6 months, the index averaged a 10% return, and over the next 12 months, it averaged a 17.7% return. Detrick emphasized that despite short-term fluctuations, he continues to expect stocks to perform well this year. The upward trend is firmly in place, and research like his reinforces this positive outlook. Bespoke, a financial research firm, presented a chart that illustrates the typical performance of stocks in the months following the start of a bull market. It indicates that while the path higher may be rocky, history has shown that stocks tend to perform well over time. Looking ahead, there are potential challenges on the horizon. The Federal Reserve is expected to pause its interest rate hiking process, which may not necessarily be a tailwind for stocks. Economists believe the pause is due to the lagging impact of fiscal policy, which could lead to a slowdown in economic growth and potentially impact earnings growth as well. Morgan Stanley has even predicted a 16% decline in corporate profits by the end of the year. However, despite these potential headwinds, historical trends and various factors such as sentiment, positioning, fundamentals, and supply-demand dynamics support the argument that being underinvested in stocks and cyclicals remains the key risk. Subramanian and Bank of America maintain a positive outlook, stating that the more likely direction of surprise is still positive. As always, history serves as a reminder that stocks have proven to be a favorable long-term investment. And despite short-term uncertainties, they have the potential to deliver solid returns in the future. Like and subscribe for more updates.